Hey, what's up, everybody? Welcome back to Investing Sucks. So in this video, we're going to be doing yet another backtesting video. So this will be the third straight video that I've done on backtesting, and I've had a really good time making these videos and posting them and seeing what you guys think. And we've had some pretty interesting discussions happen in the comment section of some of those videos, and people are sharing their thoughts on whether or not they agree or disagree with what I did, which I think is great. I think some civil discourse is how we learn from each other and we can learn new things. But for this week, I'm switching to look at deep value investing and a specific deep value investing strategy. So, for those who aren't really familiar with deep value and what it is, it's an investing strategy that was initially came up with by Benjamin Graham. He detailed it in his book Security Analysis, and then it kind of became popularized by Warren Buffett over the years. And the whole point of deep value investing is to find companies that, for whatever reason, they offer a very attractive risk reward profile. So, we know that in the world of finance and investing, risk and reward are often tied together. If we want the potential for more reward, we have to be willing to take on more risk. And what deep value tries to do is, in a way, it tries to hack that whole relationship and to find companies where, for whatever reason, they're trading extremely cheaply despite what they offer, which is some decent upside. And there isn't really a defined set of criteria that a company must meet that would make them a definitive deep value stock. It's really more of a judgment call. And I think different investors out there would probably have disagreements on what specific stocks should and should not be considered deep value or not. There's always going to be some sort of argument around that. And one common method that people use to identify deep value stocks is what's called net stocks. Again, this was invented by Benjamin Graham. And basically, what net stocks are stocks that have their current asset value, so current assets being things like cash and cash equivalents, receivables, inventory, prepaid expenses. So you take that, you deduct their total liabilities, so all short-term, long-term liabilities, off-balance sheet liabilities. You also deduct any preferred shares if the company has preferred shares. And then you're left with what's called net current assets, and you compare that to their market cap. So if that value is above their market cap, then you're basically saying that the company's net current assets alone, minus all their liabilities, is worth more than what the company is currently selling for, which makes it a deep value stock by that logic. And what this is really meant to do is kind of be a proxy or an estimate, really, of a very conservative estimate of the company's liquidation value. So basically, if the company were to cease operations and sell off all their assets, pay down all their liabilities, and then whatever is left over, they would give to the equity holders. If that amount is higher than the market cap, then in theory, the company has untapped value because essentially the company is worth more if it just stops operations and sells all its assets. So the beauty of this strategy really is that it values a company using only its balance sheet. It doesn't value the company based on a future estimate of earnings. It's really just, what does the company own as of this point in time? So what can I get if I were to buy this company? So what I did here was I created a script, and it's a public script that anyone can access as well on my website here, tickernomics.com. It's called Benjamin Graham Net Stocks, and how it works is you just kind of go here, and then once you select it, you can click Run, and then it will take you to My Scripts, where once it's on My Scripts, you click Run again, and it's going to generate a list. So this list is going to appear here in the Insight tables. So we can see now it's done. So we just go to Insight tables here, and here's the list. So we can look at these companies, and these are, as of me just running this list now, these are all the net stocks on the stock exchanges that I have on the website, which is NASDAQ, New York Stock Exchange, and the Toronto Stock Exchange. So like I said, I do want to do a backtest this net stock investing strategy to see if we had purchased net stocks specifically, would we have outperformed the market? And I guess the logic behind that, or why you would think that you're outperforming the market, is because of what deep value investing actually aims to do, which is it supposedly is finding stocks that offer a more attractive risk reward profile than the average company, which we could say is the S&P 500. So because of that logic, you would expect this strategy to outperform the market on average. Because again, we're taking advantage of humans' tendencies to avoid companies that are destined for failure or seemingly destined for failure, but maybe still have some decent future prospects ahead of them. And this means that not all stocks are probably going to outperform the market, not all net stocks, that is. And of course, there's going to be some variance in there. But if we were to buy, say, an index fund of deep value stocks and hold it for a few years and wait essentially for the stock prices to revert back to what they should be, which is the company's fair value, then we should, in theory, outperform the market, right? Because again, these stocks are supposedly offering more reward for taking on a little bit less risk just because of the nature of their business and how, in theory, you could just buy the company up entirely, liquidate it, pay down all liabilities, and then just pay yourself the difference and make money doing that. So in order to backtest, I had to create another script on the website here, which is basically the same script that I just showed you, but 5 years back in time. So it's a 5-year backtest. The site has 10 years of financial statement data, so I think 5 years is a long enough time horizon that it should make for a decent backtest. And again, really the theory is any stock that meets this net stock filter, we should expect it to offer, the better risk reward profile. So we should expect it to outperform. So I just ran this, and then if I go to the tables here, we can see what some of the stocks were as of 5 years ago today, which is September 17th, 2022. So here's a few of those companies, and then we also have the industry in here. And there's a little bit less in here than you'll notice in this filter. This filter actually has quite a lot more stocks. And I think you probably know the reason why that would be. Again, if we're assuming the reason we're buying these stocks in the first place is because, say, if the company goes bankrupt, then we're still protected as equity holders. So because of that, a lot of these stocks probably went bankrupt. And the only way that they're going to appear on this filter that I'm running here is if they're currently on the stock exchanges, because I am pulling historical data, but the company does need to exist on the stock exchanges today in order for me to actually be able to access it and get the historical data. Because if they're no longer on the stock exchanges, then they're not going to appear here. So what I did was I actually ran these two filters a few days ago, and then I summarized the results in Excel, and I think it reveals some pretty interesting insights about this strategy and about whether or not it actually works. So let's dive into that now. Right, so here we are in Excel, and let's first run through some of the key insights that I got looking at the net stock filter as of me running it today. Or actually, I ran it a few days ago, so September 13th, 2020. And the number of deep value stocks that appeared there was 356. And of those 356, the median market cap was 42 million. So that's the median. That means half of the market caps are above that, and half of the market caps of these companies are below that. So from that, we can tell that when it comes to net stocks, there's going to be a lot of very, very small micro cap companies. And if we look at some of the actual companies that appear here, you're going to see a lot of biotechnology stocks. And biotechnology actually made up 38% of the industries that appeared here. And even if it wasn't a biotech stock, there's a lot of other industries in here of something related to biotechnology, as we can see here, diagnostics and research, medical devices. I mean, a lot of these companies kind of fall into the same category. So I may be wondering why that is. And it is kind of an issue because these biotech stocks might, if you're not aware, they might actually attract a lot of deep value investors into looking at biotechs, which biotechs, especially small cap biotechs, are the ultimate form of speculation when it comes to stocks. I mean, you may as well just be buying a lottery ticket at that point. But the same logic behind net stocks should still, in theory, hold, right? Because if they're trading below liquidation value, then in theory, you could just buy up the whole company, liquidate it because now you control the company, sell off all the assets, pay down all liabilities, and what's ever left you get to keep, which if that's above the market cap or the price you paid to acquire that company, then you're just going to make money. And if because these companies aren't very large, a lot of them are, say, well, we know that half of them are worth less than 42 million, then why don't you have a bunch of people with net worths in the hundreds of millions or even billions just doing this constantly and just making easy money doing it? Well, the problem is that's not what these companies are actually designed to do. All they're really going to do is just raise a little bit of capital, raise some initial financing, and then just keep spending that cash on research and development until they either invent a revolutionary new drug that makes them billions of dollars. And if you're a shareholder of that company, then obviously you make a ton of money, or they're just going to keep doing that until they move into bankruptcy. So that's why it's the ultimate form of speculation. They just raise a little bit of equity, spend it, and if nothing happens, that's basically the end of the story. And it's hard for an investor to really gain control of a company or gain 100% control, because that means you have to convince every single shareholder of that company to sell their shares to you, which is it's difficult to do. You can't just take the current market cap and say, all right, I'm going to buy the company for that, because what it actually involves is convincing everyone who holds stock in that company to give you their stock. So it's a little bit more complicated. I mean, it sounds good in theory, but in practice, it doesn't really work. And the largest market cap of all the companies was just under $7 billion. And it's a company called Interactive Brokers, which I'm sure is a company a few of you guys are familiar with. But I wouldn't really consider this a deep value stock. And there actually were quite a few companies in the asset management space. You could see that was the second most common industry, although it was much less common than biotechs. And there's a lot of like similar companies like in asset management, also capital markets, hedge funds, like those types of companies. And I think the reason they're there is really just the mechanics of their balance sheet. They're not really deep value stocks because they take money from their clients, which they record as restricted cash, or sometimes they call it client receivables. So it's on their balance sheet. It's technically a current asset. So it appears as part of that current asset metric. That's part of the calculation. But it's not actually money that the company owns and they can just distribute to shareholders if they wanted to. So for the back test, what I decided to do was remove some of those companies, remove some of the garbage, basically, like get rid of all the biotechs, get rid of asset management companies, anything in the medical space, anything kind of in the financial space where I think the only reason that they were included in the net stock filter was just because of the mechanics of their balance sheet. Any stock like that I got rid of because I just wanted to look at pure deep value stocks, companies in some industry that, again, for whatever reason, they're trading extremely, extremely cheaply. And if we look through the industries, which we can see, I'll zoom in a bit here on the right of these cells, we can see there's a few, like we can see REITs. There's another example of what I'd remove. But here's a software company, so that might be interesting to look at. Packaged foods, that might be an interesting one. And we can kind of just go down the list and see what companies are there. And again, this script is available on my website. So if you guys want to take a look at it yourselves and look into some of these companies, then I definitely encourage you to do that. Okay, next let's take a look at some of the results of the 5-year backtest of this strategy that I did. So upon initially running the filter, there were 91 total deep value stocks that appeared, but after filtering out some of the industries that I mentioned, like biotech and asset management, we were left with 34 companies. So definitely much less. And like I said before, there is going to be a little bit of survivorship bias, which you may say that's going to skew the results, which it is true to some degree, but if you think about it, the same logic for deep value stocks should still hold, right? Because these are companies that are trading below a conservative estimate of their liquidation value, which just doesn't really make any sense, right? So if that's the case, then you still should have that margin of safety when you invest in them. And because of that, these companies still should produce positive returns over the long run. So I think the logic still holds for the companies on an individual basis, even if there is a little bit of survivorship bias. So 34 companies, 15 of those companies you would have made money on, and 19 of those companies you would have lost money on. So you're losing money on more companies. But if the companies you make money on end up making you more money than you would have lost, then it's still worth it, right? And what I also decided to do was normally when I do a back test, and it's kind of a back test of a group of stocks, I would assume that you invest in them at market cap weights. But for what I did here, I assumed equal weights. And the logic behind that was because the market caps vary quite a bit. Like you can see the market cap column here. If I zoom in, there's some that are in the billions. There's even some that are in the tens of billions, but the vast majority are lower than that, right? They're only a few million. So if I were to do it at market cap weights, the results would just be way extremely skewed towards the larger companies. So I did it at equal weights, which means if there's 34 to just under 3% of your portfolio is going into each company. So what was the actual results? What would have been your 5-year return on those companies? It would have actually been negative 0.66%. So you may see that and think, well, that alone there, that invalidates the whole deep value investing strategy because clearly if you buy these stocks, on average, you're going to lose money. And I would argue it's actually the exact opposite of that. And this number here actually strengthens the case for net stocks as an investing strategy. And I'll explain what I mean by that in a minute. But what I want to do first is take a look at some of the actual companies that appeared here and show you what some of the 5-year returns were. So we can see there were a lot of companies that were real duds, right? Like this one lost 37%, and this is compounded annually. This isn't just total return over the 5 years, this is annual. But there were some companies that did really well. We can see this one here, Tatron Components. This one did pretty well. This one here, G. Willie Food International, returned 73% annual over those 5 years. So that's 73% per year for 5 years. I mean, that's a fantastic return. And even this company here, Richardson Electronics, just under 33% return, which that's a return that rivals companies like Microsoft, Apple, and Google. So the whole point here is that not all of the net stocks are going to be winners, right? And that's kind of how it should be. If every single net stock was a winner, then the strategy wouldn't really work, because then you could just have algorithms and machine learning bots that would just analyze companies that as soon as they're a net stock, they just buy it, and then the price just immediately corrects, and now it's no longer a net stock and there's no money to be made. But what makes this strategy good is the fact that not all these companies, and in fact, on average, the companies aren't going to do well. So you have to use your judgment. You have to use your, ability as an investor to actually understand the context of the company and say, okay, this is the reason why it's so undervalued. Is that a legitimate reason? And do I think there's a reason why that reason may be false? And then from that, you can determine if those are true, then maybe this would make for a really good investment, which, as we can see from the results here, if you are able to do that, then you are going to find some really good investments, which is why I like this filter, because even though, like we saw, there is quite a bit of garbage, there are some diamonds in the rough hiding in there. So at any point in time, you could run this filter, and somewhere in there, there's going to be winning stocks. Okay, so the last thing I want to do is to give a quick example of one of the companies that appeared in the current net stock filter when I ran it earlier this week, and actually talk about the company a little bit and do what I just talked about, which is try to understand the context and try to understand the reason for them being a net stock, and if that reason is actually valid. So the company is the one highlighted here. It's called Laird Superfood Incorporated. It's a packaged foods company, and as we can see here, they have 37 million in current assets and just 9 million in total liabilities. So that's about 26 million in net current assets. And their market cap is 22 million as of me running this filter. So they're a classic net stock. So what's the actual reason for this? Well, if we take a look at their stock price initially, we can see it has come down pretty significantly. They IPO'd in 2020, and the company is they sell vegan food, just various of these vegan type products, and they're based out of Oregon, the United States. They are a US company. There were quite a few non-US companies that appeared in this filter. And we can look at their financials. So we can see right here, current assets 37 million, and then total liabilities 9 million. So I did take a quick look at the company and just read their annual report a little bit to try and get an understanding of what's going on and why they're valued so lowly. And what's actually interesting is this company, about a month ago, they received a takeover offer for $3 per share from a private equity company. So $3 per share, and their current share price, if we look here, is 2.3. So $3 is actually a pretty large premium for this company. And this kind of highlights what I was talking about before, how if you do want to buy the entire company so that you can then liquidate it and try to make money doing that, you have to pay more than what the actual share price is. So maybe this private equity firm, they see the potential in that. They see that they're basically a net stock, and at $3 per share, they're not quite a net stock anymore at that level, but they are pretty close. So maybe this company sees the ability to just make a quick buck and say, we can buy the company for this price and we can just liquidate it. Or maybe they have some plan to actually turn the business around. I don't really know. But for whatever reason, they think it's worth $3 per share, and the company is yet to accept the offer. And as far as what I saw, I couldn't really see any reason for the offer being declined or rescinded for whatever reason. So I think the offer still stands as of today. Personally, I didn't really see any reason for this company to be a net stock. Like, I looked through the news, I didn't really see anything specific, like say there's a major lawsuit that's pending against them. I really think the reason is just due to concerns about the business and the products that they're selling not being able to actually sell that well. And if we look at the income statement, it's pretty telling. And if we look at what revenue is done on a quarter by quarter basis, if we go back to 2020, we can see it was growing pretty significantly. And then it hit kind of this 10 million per quarter run rate. And then it's since come down from there. And if we look at their expenses, we can see they're not making any money at that current level. Even when they're at $10 million in revenue, their operating income was negative 7 million. So the fact that the company is no longer growing and they're not making profit probably is signaling to investors that this is a failed business, right? It just does not work. And it is a direct to consumer type of company. These companies tend to have very high marketing costs because that's what they have to do in order to get people to learn about their products and go to their website to actually buy it. So that's probably the concern there. It's really just basic concerns about the business, nothing specific, no external event. So kind of just a classic deep value stock. And again, this kind of highlights the fact that if you were to invest in this company, you would need to have some reason for the business to turn around, right? Because we did talk before about how, in theory, you could just buy the company for its market cap, liquidate all the assets, pay down liabilities, and just pay yourself the difference, which maybe that's what this private equity firm is attempting to do at $3 per share. And they have to pay a bit of a premium in order to actually do that. So in order for this to actually be a net stock that ends up being one of those that performs really well, which we looked at a few examples of that, I think you need to have some reason for the business to actually turn around because otherwise they'll probably just keep spending all this money on marketing, reducing their cash balance, which reduces their current assets, and then they'll just keep burning cash until they get to a point where the company either goes bankrupt or maybe they just sell for an amount that's a lot lower than their market cap. So I wouldn't necessarily be looking into this company any further. From what I can tell, it seems pretty clear cut why they are valued the way they are, and I think it is fair. But of course, someone out there may disagree, and they may have some reason to think that the company's going to turn things around. But I'll keep an eye on this one, see in the future, see what actually plays out, because I think it'd be pretty interesting. But anyways, guys, that pretty much does it for me for this video. So thank you so much for sticking around and listening. If you did enjoy it, then please leave a like. And if you're new to my channel and you like this content, then please consider subscribing and I'll see you guys in the next video.